Hey traders, Mike Sir here. Every 3 months, publicly traded companies are required to report their quarterly earnings and provide updated financial statements to their investors. Now, this time period is referred to as the earnings season. And for traders and investors, it's an opportunity to profit from the release of important financial information. For example, speculators may try to predict how a company's earnings may perform, whether they beat analyst forecasts or not. Or traders who look to play the wild fluctuations of a stock's price, especially if they report unexpected earnings. So in this video, I'm going to share with you a few trading strategies that you can play pre-earnings and post-earnings. So let's get started. First off, let me explain the term earnings season in more detail with you. Now, earnings season refers to one of the busiest times of the year during which most quarterly corporate earnings are released to the public. Now, they typically begin in the month following most publicly traded companies' fiscal quarters, which will be January, April, July, and October, and generally last about 6 weeks after the start of the season. It's this time period where investors assess the intrinsic value of stocks and determine whether the financials match up with the market value of the companies. In addition, it's an opportunity to see if the companies beat, meet, or miss analyst expectations or financial projections by company management. Therefore, the financial results reported by the companies have a big role in the performance of their stocks. For example, if a company shares with investors that they expect to be very profitable by the next earnings date, but when they do report that they were actually not profitable, then the stock price could take a big hit. Or if a company reports unexpectedly good earnings that the market didn't anticipate, then the stock price could rise sharply. So the question you may be asking is, how do I know whether the company is going to report good earnings or not? Do we just guess or gamble, or do we listen to stock analysts and let them tell us what we should do? Well, the answer is no. The simple reason is unless you have insider information on what the company's earnings are, then you're just gambling because you don't know. But the other question which surprises a lot of novice investors or traders is when a company reports record earnings, but the stock price actually falls after the earnings report is announced. Now, why is that? Let me explain these questions next. Before I share with you how to trade company earnings, I want to let you know that this video is sponsored by Seeking Alpha. Now, they are the world's largest investing community that empowers investors to make the absolute best investing decisions by leveraging independent and balanced stock research from professional and individual investors. Also, they provide reliable news that enables investors to understand why the market and the stocks in their portfolio are moving or about to move. In addition, they provide professional caliber fundamental analysis tools in the hands of every investor. For example, their factor grades and quant ratings summarizes each stock's characteristics, and each Seeking Alpha's authors' ratings provide a snapshot of their contributors' qualitative opinions. You can sign up for a free Seeking Alpha account today, and if you like their premium features, they're currently offering a special promotion for my viewers where you would get $40 off the annual plan for their premium service. Please click on the link in the description box below to take advantage of this offer and start your stock research today. Okay, back to the video. Now, the way that I'm going to share with you how I trade company earnings will be broken down into two different strategies. One strategy is on how to profit before a company reports its earnings. The second strategy is on how to profit after a company reports its earnings. First, let's talk about a strategy where you buy a stock before it releases its earnings, and as the stock price goes up, you sell it prior to the day that it announces its earnings. Now, this means that you don't hold the stock over earnings because you don't know the results of its earnings. The key is to choose a fast-growing company stock that has the potential to go up in value. Now, the way to find these companies is by going to seekingalpha.com, and you can filter out the top growth stocks by various criteria. Now, once you filter out the companies that meet your criteria, what you want to find out is if the company consistently beats earnings forecasts, and if it does, the stock price will probably go higher prior to earnings. So the trading strategy is company stocks who have favorable past earnings or have consistently beat analyst earnings estimates every quarter will usually see their stock prices rise 2 to 4 weeks prior to their scheduled earnings announcement. Now, the rationale behind this theory is that traders who expect the company to report very good earnings will look to buy the stock beforehand or buy before the earnings is announced. They expect the positive earning news will push the stock price higher and thus be able to generate a good profit. Now, let me show you an example. First, on the Seeking Alpha site, type in the company stock that you filtered. So, for example, let's say Apple stock, AAPL. So you go to the earnings tab and click on the earnings surprise link. Now here you can see that the Apple stock has consistently beaten earnings forecasts and surprised to the upside for the past 12 quarters. So what you want to see is, does the stock always rise 2 to 4 weeks prior to them reporting earnings? So here's a chart of Apple, and I've listed the dates that they report earnings for the past 5 quarters. And you can see that the Apple stock price does indeed rise 2 to 4 weeks prior to earnings announcement for 4 of the last 5 earnings announcements from 2021 to 2022. So once the stock price has gone up to the date of the earnings, you would sell and take your profits because it would usually fall on the date of the announcement or shortly after the announcement, even if the company meets its earnings expectations. Now, the simple reason is it's based on the concept of buy on rumor and sell on news. So basically, traders would buy on the rumor that the company is going to report good earnings, and then once they announce the expected good earnings news, then they would take profits on the news. As I mentioned, it's not suggested that you hold a stock over their company earnings announcement because you don't know what the results will be, and even if they do meet or beat earnings expectations, you could see the stock price go sharply lower. Now, a perfect example was Netflix, which beat on profit and was in line with expectations on revenue, but shares plunged on slowing subscriber growth. Now, here you can see a chart of Netflix, the stock price down over 30% after the earnings announcement. Now, obviously, there will be times where you hold over earnings and the stock price moves up and you make more money. But it's much easier to make the easier money prior to earnings rather than try to speculate how the market will react to its earnings afterwards. Another trading strategy related to company earnings is when a company unexpectedly reports terrible earnings or surprisingly misses analyst expectations. So what you want to look for are companies who are expected to report good earnings and the stock price rises before the earnings date. But on the earnings date, they report poor earnings, and now the stock price will obviously go down. And this is where you want to take advantage of short selling the stock and make money when the stock price goes down in value. Now let me show you an example. Meta Platforms, which is Facebook, usually beats earnings, and you can see here in the last 5 to 6 quarters, they have surprised to the upside. But in December 2021, they missed earnings expectations and the stock price fell sharply. So the trading strategy is that after a company reports unexpectedly poor earnings, you should look to short sell the stock and bet on the continued price decline in the stock price. Now here's a chart of Meta, and you can see the stock price gap down here and continue to go lower. In fact, the stock price fell over 43% in value over a month after reporting earnings. Thanks for watching. If you like these types of trading strategies, please hit the like button, subscribe button, and notification bell. I'll see you all in the next video.